Hey, Rent Retires, it's Adam Schroeder here with another episode, and Zach and I are going to be flying solo today because we want to talk about market updates with you. We realize we don't do this enough with y'all, so we're gonna just give you these two big, beautiful faces here today, and we're gonna talk about the market, and then we're gonna talk about a big, beautiful bill. So we're gonna dive right in, and that is what's going on in the housing market today. We've seen a little bit of recent day change, but for the last 17 weeks, that's over 4 months, primary mortgage rates have been below 7%. Purchase applications on the year are up 18%. So what does that mean? Well, I think it's pretty obvious, Zach. Mom and pop are coming back. The homeowners are coming back. And so what does that mean for us? Well, it means more competition, which tends to lead to, what was it, Zach? What happens when there's competition? Prices go.
Yep, they're gonna go up, people. We've been saying it for a while, and you're right, Adam. I think thanks for pointing out those trends because really the point is that a lot of people have kind of sat on the sidelines or not done anything, waiting for interest rates to drop. And time again, we tell everyone like that's not when you want to invest. Well, one, you want to have consistency investing over time. It's kind of the equivalent of dollar cost averaging in the stock market, but really the reality is that when you understand real estate, time is on your side. So the sooner you invest in real estate, the sooner things start to compound. But interest rates are only a point in time. And so, yes, when interest rates, they are actually, as Adam just showed, there's coming down slowly, and everyone is anticipating interest rates to continue to come down over time, probably more aggressively over the past or the next 2 years of what we've seen over the past year to 18 months. In addition to, regardless of interest rates, we've already seen that housing activity has picked up from the residential buyer. Now the last piece I'd like to add in here that Adam did mention is that we still have a supply constraint in general. And so when we have, slightly lower interest rates, we have more residential buyer activity. On our end, we're also seeing an increase in investor activity because that's what we specifically track. Where all the other stats you'll hear is about residential buyers. So both residential and investor activity is picking up. Interest rates are coming down slightly, and they're maintaining lower levels than they were a year ago, as well as inventory still being a supply constraint. That's all. That being said, is just there's no other option but prices to go up, and I think that trend will continue. Usually, real estate trends they don't happen overnight; they happen very slowly. And so, one thing we've learned over time is you need to be really keen to notice when trends start to happen. Because before you know it, just like when, if you're thinking about a recession, most people don't realize, 6 months into a recession, all of a sudden now we're officially in a recession. But housing trends are very slow. And so my point here is that if you can be keen to actually understand the market trends when they're starting in the early levels, you can be a very strategic investor. For example, right now is a crucial time because you can acquire assets still where you have all these crazy builder incentives. There's not as much competition, even though it is increasing over time. You can still make really good investments and ride that appreciation wave that's likely going to happen. Now, we're not going to see 2020 through 2022 appreciation. That's unsustainable, right? And then it's just too cyclical. But I anticipate my theory and crystal ball look into the future here is that we will likely see a strong appreciation over the next 1 to 4 years, over the next 4-year period. After that, who knows what's going to happen, but we're likely going to see, strong appreciation during those times. Over the past 2 to 3 years, we haven't seen much, right? There are some markets that are doing well. All that being said, now is a crucial time, I think, to make investments and get in front of that curve, because what our objective is today is to tell you that the market is changing and is changing in a positive direction for sellers, not so much for buyers. So, Adam, anything to add to that?
Yeah, I think it's important. We hear some people are concerned about the inventory in certain markets, and they talk about how it's taking longer to sell. When we talk about longer, they're talking about 90, 100 days. That's normal. That's not abnormal at all. I mean, it wasn't normal for the last 3 years, 4 years because of COVID, but that's normal. And I was looking at housing inventory. And if you look at where housing inventory is right now in May 2025, it's at 959,251 units across the country. In May of 2018, pre-COVID, We were at 1,156,921 properties for sale. So while inventory has gone up, we're still 200,000 units below where we were 7 years ago. And 7 years ago, it was a great time to invest as well. There are only 8 states that are back to pre-COVID levels of inventory. So yes, it's up, but it's up from a bottom, right? Like it's not exactly like we were here and we went higher. We were down here on the floor and we inched up to, the fourth step or fifth step on the way to the second floor. So, or we came up from the basement, maybe. I don't know. In Texas, we don't have basements, so I don't ever think about that. But yeah, only 8 states are back to pre-COVID levels of inventory on the market for their buyers.
Adam, how does that influence? And I think people would want to know, well, like, what are those states? Because and should I be investing in those states? I mean, my question to you is, does that matter? Like, do those specific states? We're looking at a general trend, and of course, when we look at statistics, it's all relative to what we're comparing to.
Yeah.
And so I'm good that you put context around that of like, what are we actually comparing that to? And is this normal, just to have a more comprehensive understanding of market trends? But let me ask you,
Yeah.
do we pay attention to those states? What does that mean? Does that mean that those states are slowing down, or they're getting an influx of inventory? Maybe add some light.
Yeah. So I was looking, I didn't write down all of the states' numbers because I was running and trying to find some really good markets to find new inventory in. And I looked at, there was a page on, I don't remember if it was the census or somewhere, that showed kind of how each state and where their inventory level was now versus, I believe it was 5 years before. And I think the top state was only about 16% over where they were pre-COVID. There's a lot of them that were in the significant negative numbers. I mean, I'll run through a few of the ones we're in. Minnesota, there was negative 36% inventory. In Iowa, negative 25. In Indiana, negative 23. In Ohio, negative 37. In North Carolina, negative 22%. In South Carolina, negative 18%. In Georgia, negative 15%. I mean, we're seeing significant inventory shortages well, first off, I removed the landlord unfriendly states, right? These were some landlord friendly states I just rattled off that investors have known about, enjoy, all of that. And so you're seeing some pretty significant numbers. I mean, I think the highest state that we're in right now is like Oklahoma, which is flatline. Like it's at a zero. Their inventory now is the same as what it was like 4 or 5 years ago.
Yeah, go ahead. Sorry.
Yeah. So, I mean, it's just a lot of these states, they're still in significant negative territory and are trying to work their way up to where they were. They're just, just taking their time.
Well, when I look at that, I mean, and those are all the states that we operate in, that you just mentioned, and those are significant when you're talking about 25 to 30% shortages. In relative, I think it's also important to compare pre-COVID times, because in my opinion, that was more of the last kind of normal real estate market we had. And I think we're starting to get back there. We'll see over time. But when we talk about significant shortages of inventory, those are the areas you want to be in, right? Because there's now those are also likely the most competitive for investment purchases and residential buyers. And those are the first ones to see the trend, where as soon as the residential buyers start entering the market again at strong levels, and likely some institutional buyers as well, that's where there's going to be extreme competition, and where you're likely going to see the highest appreciation in areas where you have a shortage of houses. So that's certainly an important thing to look at and consider, something that we do when we evaluate markets, because when you have a undersupply of housing in those areas and a deficit, especially relative to where we were 7 or 8 years ago, and the population is likely increased. That's the other thing too. That's, adding to that trend. Most all of those markets you mentioned are growth markets where the population is increasing, especially in the Southeast. But those are areas where you have an undersupply of housing. Investors are looking to buy houses for that reason. Retail buyers are looking to live in homes. That's going to cause, people to rent homes. You're going to have more tenants. You're going to have likely higher appreciation, both in rents and home prices. And you have a larger buyer pool, both from investors and residential buyers, in an area that has an undersupply of housing. So that's how you position yourself for success. And again, real estate trends are very slow. So it's hard to say. Most people look at the news and say, oh, that's the trend. But that's the trend that's been happening for 2 to 4 years. and that trend is already on the back end of the bell curve. So you want to be on the front end, and that's what Adam and I are trying to call out today. The other thing we want to talk about,
I want to dive into one more thing before we get to the topic that's going to make Zach have a big smile on his face. And that is that right now, a lot of times, and I've said this before, I tell it to people on webinars all the time, right now is a great time for any level of investor, because a lot of times people, you hear about the gap between the conventional lender, like the Fannie Mae, Freddie Mac loans, and your DSCR loans, your debt service coverage ratio, which you have to use if you have more than 10 Fannie Mae loans, or if you're not a U.S. citizen, all of that. And I spoke with one of our lenders and talked about rates with him. And he said, and these were with no or very, very minimal, like $500 in points being paid. Because with DSCR loans, you usually have to pay something to get the loan. But with no points, conventional loan and DSCR interest-only loan percentages are the exact same. And a DSCR loan, a 30-year fixed, for $500 on a $250,000 purchase price, is actually a quarter point lower than conventional loans. So even if you have to come in and do a DSCR loan, just know that your terms right now are phenomenal. And if you're coming in and you don't have any conventional loans, it might be a really good idea to hold off on using those loans and use the DSCR option right now. So make sure you talk to your lender. This is why it's so important to actually get a lender who knows what they're talking about, because we'll have people sometimes who come to us and want to use a random lender, and okay, whatever, but then you talk to them about what their lenders told them, and they're only being pushed in the conventional route because that's all that lender does.
Yep.
So talk to the lenders you're working with, see if they even offer these loan products. A lot of them don't, because they don't have the investors to sell the loans to or to work with to get the loans from. And so make sure you talk to them and talk about all of your options. Don't just say, well, I don't have any loans, so I want conventional. Let's talk about that. Talk about every single loan option out there. Think back to the last time you bought a property. Did you love the mortgage process? No. The team of investor financing strategists at BLUPRINT Home Loans have created a better way by simplifying the lending process. They're investors too, and they understand the problems you experience with traditional residential mortgage lenders, which is why they created an investor-focused team that will give you the blueprint to build and scale your portfolio. BLUPRINT Home Loans is a creative, direct lender who lends in every state except New York, so you can easily change markets without having to change lenders. Whether you're just getting started or looking to scale, they're the strategic partners you have been looking for to help you achieve your goals. BLUPRINT is 5-star rated on Google and have helped thousands of investors over the past 20 years. Their team of conventional and non-conventional lending experts love talking strategy and will help you scale your business. To schedule your no-cost strategy session, call 888-343-1043 or go to blueprinthomeloans.com/rent-to-retirement. Looking for an edge in real estate? For over 30 years, RealSource Residential has pioneered research on real estate cycles and market timing. They don't just follow trends. They identify them with analytics to pinpoint high-growth markets. RealSource Residential offers access to invest in prime multifamily opportunities where underperforming properties are transformed to unlock value and maximize passive income. Visit www.realsourceresidential.com/RTR to subscribe for real estate insights, market reports, exclusive opportunities, and tools to grow your wealth with confidence. RealSource Residential, where experience meets innovation and investors come first.
As part of being a savvy and sophisticated and successful investor is knowing the loan options. I talk about it all the time. I get multiple quotes from multiple lenders on every property I buy, even if I have a great relationship. And even if I think I'm going to use a particular lender, I always want to, checks and balances, make sure they're offering the right products, make sure I understand, because loans are changing all the time too. That's the other thing, is the lending world is a dynamic world, and there's all sorts of new options, and the terms of the loans are changing, the rates. This is the first time that I've been aware of that we've seen DSCR products be comparable and even better than conventional products. And to Adam's point, it's like, why not take advantage of that? One, if it cash flows better, you have better rates, lower fees, potentially you have the asset protection. The podcast we did was around asset protection and separating out assets. So buying in DSCR loans, which has historically been something investors only consider after they max out their 10 loans per person, because generally those have been the better, more attractive rates. Well, now you can, look at DSCR, which does open up an opportunity to have, in my opinion, safer and better loan products in place that's tailored towards investors. And when conventional, like you said, Adam, when conventional comes back as being a more attractive, lower rate, then you still have all those spots saved. So this is a perfect thing to consider. And this also speaks to kind of the market cycle that we're in right now, just from a lending dynamic. And I anticipate this trend will change as well as we start to see rates start to come down. But I do want to say one thing, guys. We talk a lot about, Adam, you always hear us on here about like, hey, now's a good time to buy. Now's a good time to buy. Very seldom or ever will we get on here and say, don't buy real estate. And we truly believe that. But my point is, and hopefully what you've been able to just pay attention to and extrapolate out of our conversation, there's always a unique approach and strategy of how to be a strategic investor in any market cycle. And that's what it's really about, right? It's not about arbitrarily buying real estate all the time. Consistency is a key to success. But our goal is to point out how you can be a strategic investor in today's market to pay attention to these curves. So buying in areas that have a significant undersupply of housing that we just called out, maybe using DSCR loans, still taking advantage of builder incentives, also in these areas that have supply constraints that won't be available for a significant amount of time. These are the things that you should be paying attention to in today's cycle, because there always is a way to make real estate make sense in any market cycle. You just have to know what to do.
Yeah, I've been called a perma bull before, and I'm not bullish on every market all the time, but there's definitely always a place to buy at any given point, like Zach was saying. So let's get to the big beautiful build that's going to put a big beautiful smile on Zach's face. If you've listened to this podcast for more than probably, what would you say, 3 episodes, you know that one of Zach's favorite topics is taxes. And you know that one of the things that can help investor the most with taxes is getting the bonus depreciation, is accelerating your depreciation and taking that big quote unquote loss in year one and reducing your taxable income, all of your cash flow and all of that. Right now in 2025, as of today, May 23rd, that is down to 40% that you can use. But in a bill that has been passed by the House and is in the Senate, and they are working through it as well. You can see here on 522, Buchanan, Ingersoll, and Rooney, which is the national law firm, talked about how this bill is going to reinstate 100% first-year depreciation for qualified property acquired and placed in service after January 19th, 2025, and before January 1st, 2030. It's coming back, people. It's coming back.
Yeah, and we're not here to be political. We're just looking at what is going to affect us as investors. And this most certainly is something that will affect us, I think, generally in a positive way for multiple reasons. But of course, the 100% bonus depreciation is very big. And so just the details with this, if you bought the property after January 19th, that seems to be the cutoff as of now. So, if you bought properties in end of January throughout the rest of the year, you should be good there. And this also means that, this can play into your planning in your strategy moving forward. We all anticipate to be at 100% bonus depreciation. And I know me personally, as well as, our team, we're making investments based on the decision, the assumption that we will be there for this year and next year and likely, future years, depending on if it's phased out or if it becomes permanent, likely be phased out over time. But all that being said, we've done extensive coverage on accelerated depreciation. There is a way for every single person to take advantage of this. Yeah, I'm not a CPA or attorney, but we have very good ones, and we've interviewed them on our YouTube and podcast, so you can certainly check those out. But just as a quick recap, guys, on how this stuff works, there is every single person can take advantage of doing a accelerated depreciation or a bonus depreciation with a cost segregation study. Where it really becomes attractive is if you take that passive loss against your active income. And there's really 2 ways to do that. But let me just restate that. Every single person can accelerate your depreciation. You don't have to be a real estate professional. You don't have short-term rental. You can do that. And some people may make sense to do that if they have, significant income, significant passive income from the investment property. But in most cases, people are attracted to doing that to offset their active income. And we have our investors that are doing this all the time. But you need to approach it correctly. And that's why speaking with our investment strategist to help you map out the strategy and the plan is really important. And even those people that can't take advantage of it today, you can backdate it. So even if you buying a property this year, if we're back at 100% bonus depreciation, you don't have to take it this year. You can work towards, if you can't qualify for real estate professional status, you or your spouse, because let's say you have full-time W-2 and your spouse is maybe part-time or stay at home, maybe they can oversee the real estate portfolio and get real estate professional status, filed jointly, still offsets against your active income. That's something that you can possibly be forward thinking about. Well, hey, if this is my first investment property, maybe in 2 to 3 years, I can qualify for real estate professional. Well, now you can still take the 100% bonus depreciation backdated to the year that you bought the property. Same thing with today. If you bought a property in 2020, 2021, 2022, you can still get 100% bonus depreciation today. It's all about the year that you bought it and put the property into service. Guys, we won't go deep into this because there's a lot of details. But remember, every single person can do this. You can do it as a real estate professional, which covers all of your real estate portfolio, or you can do it property dependent as operating as a short-term rental, which we walk you through. And then the next year you can turn over management if you want. We help people do this consistently and save, 6 and some people 7 figures in taxes that they would otherwise pay just by buying cash flowing investment properties and being a strategic investor. And remember, if you make $150,000 or less, you can take up to a $25,000 loss. You could do cost segregation study and take a $25,000 loss against all your income sources, active income sources. This has nothing to do with real estate professional status or a short-term rental. I believe it phases out
Phases out at 100.
Well, I believe it phases out completely at 150, but the 25K phases out at 100K. So you can take additional depreciation against your active income if you're 150 or under. Again, guys, this is just to spark thoughts on how to be a more strategic investor, because the more that you save in taxes, if you actually run the return on investment of even $10,000 that you would otherwise pay to Uncle Sam, that then you can actually save and reinvest and earn income on, and then reinvest to buy additional assets that have additional tax benefits. That's how you get wealthy, and that's how the wealthy dramatically expand their wealth, is by just snowballing this. So Adam, you better cut me off though.
Yeah. And this is just a stark reminder of why, if you're going to be a real estate investor and you're even going to attempt to do this, you need to have a real estate CPA, because they're going to have to go and do this and, refile your 2025, 2026 taxes, because you're not going to put it on your 2030 taxes. They're going to go back and put it in your, the year that it was put into service, and everything's going to be amended. So just make sure you're dealing with the right team. We talked about dealing with the right lenders. Make sure you're dealing with the right CPA who knows what they're doing, so that you can actually take advantage of this. So if you want to find the inventory that you can use to offset all of your active income once you hit the real estate professional status, head on over to renttoretirement.com. Check out our inventory, schedule a time to talk with our strategist, and just figure out your plan for getting where you want to be. If you have any questions that you want us to answer in future episodes, or if you want to tell your story, email podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. We really appreciate you joining just the two of us today and educating yourselves. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.